This is Bloomberg Daybreak Middle East and Africa, our top stories this morning. Stocks and futures trade higher, shrugging off the Wall Street slide, which saw the Nasdaq 100 close 2% lower and Nvidia drop 10% Friday. Focus now shifts to earnings. The U.S. House approves $95 billion in aid for Ukraine, Israel and Taiwan. Meanwhile, Prime Minister Benjamin Netanyahu of Israel condemns a report U.S. plan to sanction a unit of the Israeli military. Europe's biggest banks pick up the baton following mixed results on Wall Street. We discuss what to expect later this hour. And we speak to the CEO of Swiss watchmaker Breitling as consumer demand weakens. It's just gone 8 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's have a look at how we are shaping up for the Monday trading session. Looks like futures are higher, but let's not be fooled. We did have a consecutive series of bearish reversals in last week's trade, and that was 6 consecutive declines for the S&P 500. We also may be into AI correction territory with Nvidia and Supermicro down substantially on Friday. The 2-year yield has reached 5%. We're going to be talking fixed income in a minute, but we are into the Fed's blackout period. And then Brent crude seems to be reverse pricing that risk on trade, 86.62 now for a barrel of Brent. I do want to point to this Nvidia chart, though, because we saw the worst sell-off since the beginning of the coronavirus on Friday, which tells you just how much sentiment had turned. We'll have to see if it stays the case. Of course, the valuation for Nvidia was a lot lower during the coronavirus period, but Julian Emmanuel, at least of Evercore ISI, says, look, AI is not done, but you want to pick the AI revolutionaries. It is, however, infecting the Asia trade today, so let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Avril.
Infecting, I think, is the right word to use here, Vonnie. We're seeing the infotech sector extending the declines from last week, but most of the stock benchmarks did stage an early rebound. It was more pronounced at the start of the session, and perhaps that sign of relief that we're not getting further escalation from Iran after that retaliatory strike from Israel last Friday. That being said, the Japanese benchmark is paring those gains from earlier on in the session. We're seeing the CSI 300 slip into negative, flip the board, because I think there is a bit more risk aversion creeping into the markets now, as well as the focus shifts towards these earnings releases later in the week from some of the big tech names. And there's going to be a lot at stake here for them to live up to all that AI hype. Indeed, for the likes of TSMC, which of course is part of that AI theme, it's seeing an wave of bearishness coming through from its options trades, for example. So these are among the big drags on the MSCI Asia Pacific today, Vonnie.
Avril, thank you. That's Avril Hong there in Singapore, and we'll check in with you again in a few minutes. Microsoft, Meta and Alphabet among the tech giants scheduled to report this week. The so-called Magnificent Seven's earnings will arrive at a crucial time as investors look for an AI-powered rebound in stocks, potentially. Garfield Reynolds leads our Markets Live Asia coverage and joins us now. So, Garfield, about 40%, as I was saying, of the S&P's market cap reports this week, but the more important ones potentially are the tech companies. Could we start to see the AI bubble being priced out? I mean, we should say we're still up 50% for the likes of Nvidia this year.
Yeah, the biggest problem I think that investors face going into this earnings season is that the AI complex has had such a series of extraordinarily strong beats on the earnings front, and the broad market is very anxious about a range of factors right now, including no Fed rate cuts, geopolitical risks, all that sort of thing. So you need some strong beats. You need not just for the AI complex to meet expectations, it needs to go on beating expectations, which it has proven till now to be very, very good at doing. But you mentioned TSMC. That's, I think, helping to underscore the nervousness going in, because TSMC's earnings looked okay on the face of it. However, there were some concerns about the outlook, especially about the idea that AI was offering a limited follow-through to other areas of the industry. And there was the animal spirits factor, as it were. The CEO for TSMC was perceived as having been a little bit downbeat with his body language more than anything else. So that helped to make investors concerned, precisely because they're busy sniffing around at the moment, trying to work out, is this as good as it gets? Are we about to see the bubble bursting? Because if you are about to see the bubble bursting, then a lot of investors want to get out rapidly rather than you end up you're getting caught with extreme declines when they can't get out as fast as they would like to.
Exactly. Well, all that money will have to go somewhere if that's the case, and it's certainly not going into bonds. Garfield, is 5% on the 2-year an important psychological level?
Well, I think 5% on the 2 years is a very important psychological level, yes, especially because if the 2-year goes through 5, then that increases the potential that the 10-year can go back to that 5% level, which last year that was a yield level that both helped to cause a lot of angst for other assets, including equities. It was also what ultimately ended up being the level where enough buyers came in to help to unwind things. And I mean, maybe in the background as well, it helped to convince the Fed that conditions were restrictive enough. So given all of that, we've got the potential for yields to go higher. And right now we have a Fed that probably isn't too concerned about yields going higher because equities still remain pretty elevated, and far more importantly for the Fed, so does inflation in the real world.
Garfield, thank you so much. Garfield Reynolds, who leads the Markets Live Asia coverage. We're going to continue talking yields now. Let's bring in Satyajit Singh, Head of Fixed Income Strategy at Emirates NBD. Satyajit, thank you so much for joining us in studio. In particular, you heard Garfield there. There's the potential for yields to go even higher, the 10-year back towards that 5% as well. Does it happen?
I would say the chance is 50-50, right? You cannot rule it out. We have seen in the last 4 largest bond sell-offs in a decade, the typical movements have been more than 100 bips, right? And we have already seen the yields move up from December 27 up by 80 bips. So another 20-25 bips movement cannot be ruled out, and 5% within reach after that.
Did we reset in the last few sessions? It felt like the Fed reset. Are we at zero again?
I mean, you have been seeing a lot of writings on the wall. A lot of analysts are saying that rate hikes are not out of the picture. But our economist view is that we'll have 2 rate cuts, one starting in July or September and one towards Q4. So I won't say we are at zero, but probably we are at 70%.
What makes you think that that's doable? Because we seem to have stalled out on progress on inflation.
Yes, inflation is one part. Fed would not like to be very proactive in terms of which can take a decision which can actually spur the growth and inflation. But at some point of time, these high interest rates are not sustainable, and they would like to cut sometime in July and September rather than wait for the election time.
Well, why would they be able to do it in July and September? Won't we have to see a string of data that shows us that inflation is back under control? Or will more people have to change their idea of what neutral is? We are getting more people doing that, by the way.
Absolutely. I mean, 2% is an arbitrary number, to be honest. And if the Fed is happy at 2.8%, then so be it. What's more important for them is to probably protect the currency and job market. And if they see a little bit of weakening, and we'll have a string of data before the July FOMC meetings, that could help them take a decision at that point of time. And they're very data dependent, to be honest.
If we don't get services inflation moderating, can they go in July?
As I mentioned, that there's a chance, right?
Yes.
Obviously, services, and don't forget that there is a manufacturing rebound as well. We'll have the preliminary PMIs coming out. So both PMIs as well as inflation, and if you look at the jobs data, they are the 3 important characteristics I think the Fed will be looking at. And if they remain strong, probably they will miss July. We'll look at September then.
How would the Fed engineer cooler demand? Would it ever want to?
Not really, not an oil expert, but in the sense that we have, at the start of the year, we mentioned that geopolitics is a key risk in our year-ahead outlook. And despite the recent uptick in geopolitics, we have not seen a lot of movement in oil as such. Even the Treasury sell-off, was not great at that point of time. So we think that this de-escalation will happen at this point of time, and oil should be range-bound. Our economist target is $85 a barrel, average for the year.
And we are close to that right now, and I guess that would help with inflation dynamics as well. Is policy at this point restrictive when you see where rates are at and how, we've seen some selling in the Treasury market? Some at the Fed are saying, yes, it's quite restrictive, including John Williams and Fed Chair Powell himself. How restrictive is it?
I would say it would be a little bit higher than neutral because we have seen a lot of fiscal impetus that has been given to the real economy as such. So at this point of time, even if monetary policy is restrictive, fiscal policy remains accommodative. So overall, markets are running with liquidity at this point of time. We have seen, as I mentioned, our manufacturing rebound, inflation growth has stalled. So I think Fed will wait before changing its tone to a more dovish in nature.
We do have a hefty auction schedule this week. Will the market have the appetite for all of this supply?
I think 5% is kind of a holy grail for the two-year yield, right? Last time we saw that, we saw a lot of appetite. Even last week, the 20-year auction went on smoothly. So I don't think there will be any trouble in the market digesting this amount of auction that's due.
Satyajit, thank you so much for joining us. A very wonderful conversation there with Satyajit Singh, Head of Fixed Income Strategy at Emirates.
Thank you.
Still ahead, we speak exclusively with the Breitling CEO, George Kern, about the drop in demand for premium and luxury goods. Plus, a 6-month political deadlock over aid for Ukraine ends in Washington. A closer look at what it means for the war in Russia. Next, this is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. The US Senate is expected to pass $95 billion in fresh aid for Ukraine, Israel and Taiwan this week after the end of a 6-month political deadlock in the House.
This aid will strengthen Ukraine. We did lose the initiative there. Now we have all the chance to stabilize the situation and to overtake the initiative.
For more, let's bring in senior editor Bill Farries. So, Bill, how critical is this latest US aid package for Ukraine? How soon could it actually impact the conflict?
Well, Vonnie, as you said, this is an aid package that the White House has been pushing since the end of last year. So it's really been 6 months of trying to get this package with the risks on the battlefield rising. In terms of how quickly some of this aid, a lot of it will be artillery, for instance, how quickly that could get flowing. The Pentagon and U.S. officials have signaled it might just be a matter of really a week or just a few weeks. They have been planning for this to pass for a long time. There wasn't clear what the vehicle for it to do so would be, but it's been packaged with some of these other military aid requests, and it looks like it could be flowing really within days at this point.
And Bill, the military aid package passed by the House does include new sanctions on Iran's oil sector, but China buys most of Iran's oil, so what kind of impact are we going to see this having?
Yeah, it's not clear. It's not clear what the big impact will be. The oil market today does not seem to be reacting to that passage at all. Iran is producing about 1.5 million barrels a day, largely going to China. Iran is already heavily sanctioned, and some of the Chinese entities that have been involved in this are sanctioned as well. This new authority allows the U.S. or allows the White House to target specific ports, gives it more leeway to target specific ships, as well as financing. But it does include these presidential waivers for national security, which basically means the White House will have authority but not be required to institute sanctions if it doesn't see it as in its interest. Heading into a U.S. election, there is not a lot of political interest in seeing gas prices rise, so it's not clear that they'll be used right away.
Bill, thank you so much for the context. Much appreciated. That is senior editor Bill Farries there. Meanwhile, Israel's Prime Minister Benjamin Netanyahu has condemned a reported U.S. plan to sanction an ultra-Orthodox army unit over human rights abuses in the West Bank. It comes after the U.S. House passed fresh aid for Israel. For more on all of this, let's bring in Bloomberg's Dana Quresh, who is our Bloomberg bureau chief in Dubai. So, Dana, what kind of an impact will this have? I mean, obviously Netanyahu is going to come out and bemoan this, but will it have any actual impact on relations?
Good morning. So yes, the U.S. reportedly plans to sanction an Israeli military unit of ultra-Orthodox soldiers for alleged human rights abuses against Palestinians in the West Bank. That would be, if it happens, the first direct sanction against Israel Defense Forces. And yeah, Prime Minister Netanyahu already called the move the height of absurdity. And we saw the finance minister as well calling it absolute madness. This has been an ongoing issue for the U.S. and it has asked Israel for more restraint, one in the West Bank and also in its war in Gaza, and not to go into Rafah for a military operation there to root out Hamas, and has also asked for more aid. Now, in terms of relationship, I doubt this would add any strain because we saw the U.S. House passing $26 billion of aid for Israel to help it with its fight against Hamas, meaning military equipment and also aid in Gaza. So in terms of this historic relationship that has really withstood and weathered a lot of the storms, I think this would still stand, but it shows how the U.S. continues to be frustrated with Israel's policy in the West Bank and Gaza as well.
What's the trajectory for Rafah and Israel's strikes on Rafah? We saw, 18 children, according to health officials, among 22 people at least killed in strikes over the weekend.
Yes, but that does not mean that Israel has started its so-called military operation in Rafah. What they want to do is that before they start this operation, they want to move people out of Rafah, which the U.S. and other countries have said is almost impossible. And also UN offices are saying this is impossible because you can't move over 1 million people who have been displaced from the war there. But Israel is adamant on doing that, and it is insisting that they will do that, move people out before they start these operations. But until now, there's no indication that they will go ahead and do that.
Dana, what's the latest on mediation? Qatar is sort of the man in the middle, obviously, one of them anyway, but it seems to be displeasing everybody, and now it's threatening to walk away as an actor on the international stage.
It's definitely a stalemate. We are not seeing any kind of significant movement on the side of these negotiations to release the hostages or reach a ceasefire agreement. Qatar said it is reevaluating its position and its standing in these negotiations, kind of hinting that it would withdraw. But I mean, it is the only place where Hamas leaders reside, especially the political bureau there in Doha. And now we saw that Haniyeh, the head of the political bureau of Hamas in Doha, is actually heading to Turkey. Not sure what these negotiations, what these talks in Turkey will probably get anywhere. But for now, it is definitely a stalemate.
All right, a lot to keep an eye on every single day. Dana, thank you so much for all the context. That's Bloomberg's Dana Kraish there, Dubai chief, Bloomberg. Plenty more still ahead, but let's take a quick look at oil before we go, because all of that risk seems to be priced out, at least of Brent. We're above $86 a barrel, but that's a far cry from the $90+ a barrel that we saw last week. Do stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. South Africa's inflation fell slightly in March to 5.3% year-on-year, but it remains above the central bank's target of 4.5%. The South African Reserve Bank governor told us it's premature to judge what the latest data means for monetary policy.
The fact that the markets get excited that the print had surprised them by 0.1 just tells you the extent of the uncertainty that we are in. We have not quite seen a discernible trend because we had peaked at 7.8% in 2022, and we were coming down nicely. We went all the way to 4.7, and then we started to go up again, and it rose all the way to 5.6, and we are now at 5.3. There isn't a discernible trend, but a look at the components of inflation makes for an interesting read. Food prices have continued their downward trend. They might be reaching the bottom. It's too early to tell because we do not know the effects of El Nino. Core has also now come down to 4.9%, and we hope that it sustains that momentum. And so too early to tell what a discernible trend would be.
Speaking of upside surprises or small surprises and big reactions, saw a similar thing in the United States last week, the other way around. You had a downside surprise. US CPI came in a little bit hotter than expected, and all of a sudden, the markets, big moves in rates, dollar a whole lot stronger, and big questions about central banks abroad and the consequences for them. Could you give us a bit of colour on that, Governor? What are the consequences for you? How independent is your policy from what the Federal Reserve may or may not do in the future?
Well, we watch the Fed, we don't follow the Fed. The decisions of the Fed reflect a key institution's take on the U.S. economy, which is the largest economy in the world. We are a small, open economy. The actions of the Fed have an impact on global financial conditions, and global financial conditions have got implications for the direction of capital flows, and thus a realignment of exchange rates. And actually, at our previous, many of our meetings in the past, we had highlighted that the tight global financial conditions have got implications for the exchange rate, and by extension could lead to an impact on domestic prices. There are a range of other factors, but we do not follow the Fed. We watch it. We started tightening policy a good 12 months before the Fed started doing it. We started in 2021. The Fed only started in 2022.
That's the South African Reserve Bank governor speaking to Bloomberg's Jonathan Ferro in Washington. And South Africa's elections will be the focus of our next Africa Amplified show. You don't want to miss that. It's coming up Friday, May 3rd, right here on Bloomberg TV. Let's have a look at how we're shaping up now for the Monday trading session. Equity futures pointed higher. Let's not let that quite fool us yet, because we are seeing chips sell off across Asia. We're also seeing the fact that we had bearish reversals for most of the week last week, and that could be a factor in the Monday session to stocks reversing course in the US session really in the afternoon. But we did have the S&P 500 break below the 5,000 mark Friday after 6 consecutive drops, and the Nasdaq 100 with its worst day this year, down 2%. Take a look at the yields. That 2-year yield at the beginning of the year was at 4.3%. We have now bypassed the 5% mark, so that'll give you a clue as to just how much we have Fed repricing going on. And we're into the blackout period now, so we do not have any Fed speakers this week. Do stay tuned. Plenty more still ahead. This is Bloomberg Middle East and Africa. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Stocks and futures trade higher, shrugging off the Wall Street slide, which saw the Nasdaq 100 close 2% lower and Nvidia drop 10%. The focus now shifts to earnings. The U.S. House approves $95 billion in aid for Ukraine, Israel and Taiwan. Meanwhile, Israeli Prime Minister Benjamin Netanyahu condemns a reported U.S. plan to sanction a unit of the Israeli military. Europe's big banks pick up the baton following mixed results on Wall Street. We discuss what to expect. Plus, we speak to the CEO of Swiss watchmaker Breitling as consumer demand weakens. It's just gone 8:30 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's take a look at how we are shaping up for the Monday trading session. Futures-wise, well, it's looking positive, but we didn't let that fool us last week. It was a terrible week for U.S. equity holders. We saw Nvidia, for example, sell off 10%, as we know, but we also had the 6th day in a row where the S&P was lower. It really makes you wonder what this week is going to look like. Mind you, there was a lot of geopolitical risk priced into the market last week, and that seems to be coming out of the market this week now, post that Iran strike by Israel on Friday. Brent crude is down well below $87 a barrel. That's a good $5 difference. And we have the 2-year yield at 5%. It's the Fed blackout period right now, so we won't hear anything more from the Federal Reserve. Reserve, at least this week. Let's take a look at this chart, though, because the NVIDIA move is fascinating. Julian Emanuel of Evercore ISI says this isn't the great AI correction. There are still opportunities in AI, but you have to pick the revolutionaries. There's the trick. But we did see the biggest sell-off since all the way back here, which was the beginning of the coronavirus period. Now, bear in mind, we are still up 50% this year for NVIDIA, so NVIDIA holders are still quite pleased with their performance, I'm sure. That said, will we see some of that move back in, or will we see continued selling today? Well, if Asia is anything to go by, chip stocks are selling off. So let's check in on just how bad things are. Avril Hong is in our Singapore studio. Avril.
Indeed, Vonnie, after NVIDIA's tumble last Friday, we're seeing Asia's chip and AI-related stocks broadly declining, and we're seeing the likes of TSMC, which after its cautious guidance last week tumbled almost 7% on Friday. It is extending those losses today. The concern here is really that potential unwinding of the AI trade, and as you alluded to, the focus this week is shifting perhaps from those geopolitical tensions to earnings as well as U.S. data. So there's a lot at play here. Flip the board, because I wanted to take you cross assets to what we're seeing in Japan. It's not just the U.S. growth or PCE numbers that we're watching out for, all those big tech earnings. It's also Japan at the end of the week. The BOJ is set to hold rates steady after that historic hike last month. But given how weak the yen has been, there is the sense that it has been affecting the inflation outlook. So this could prompt potentially the BOJ to announce the start of quantitative tightening. It could start doing this by cutting back on its bond purchases. This could put further upward pressure on yields in Japan. For now, as I say, that relief rally is underway in Japan as well, ticking higher on those benchmarks there as the geopolitics perhaps comes a bit back from the fore. Vonnie.
Avril, certainly, and we're going to continue to speak geopolitics now, but thank you, Avril Hong in Singapore. So let's turn back to those tensions in the Middle East. Last week, the world witnessed a new era as a shadow war between Iran and Israel came out into the open. One of the big questions is whether Israel will feel compelled to keep striking Iran and assets elsewhere. Let's bring in Anise Basiri Tabrizi, senior analyst at Control Risks. So it feels like a decade ago at this point, Anise, but it was only Friday that we saw that counter-attack by Israel on Iran. Iran downplaying it, obviously. But is this a tit for tat that's going to continue, or are we done now? The market seems to think we're done.
Well, first of all, thanks for having me. I think we are definitely not done. I think, however, the tempo and the type of retaliation is unlikely to continue to be the same as what we have seen between April 13 and April 19. So when Iran directly attacked Israel first, and as you mentioned, Israel then retaliated. We have seen already some potential strikes from Israel in Iraq on Iran-linked assets, and we are likely to continue to see these similar attacks in Syria and in other parts of the region. But I think for now, it seems that the two countries do not want to go into a full-blown confrontation, and that after their signaling, their messaging has been delivered through these attacks, it's time to go back to the type of confrontation that was there before April 1st, which is what triggered these recent escalations. So when Israel allegedly struck the Iranian consulate in Damascus. That means that the situation remains very, very tense, and we at Control Risk are continuing to monitor the situation continuously, because it can shift and change drastically and very quickly. But at the same time, I think for now, it seems that as the market are signaling as well, the tempo has decreased, and the type of retaliation seems similar to what we have seen between October and the 1st of April.
What about the fact that for 6 months now we've been wondering if proxy wars or proxy attacks will get worse, and if Israel will be dragged into another war on a different front? It does seem like daily we're hearing something about, South Lebanon or Syria. Does any of that get out of control?
It's a possibility, definitely something that cannot be excluded. So far, we have seen proxies such as Hezbollah, such as Hashd al-Shabi, the PMF, which are located in Iraq, being able and willing to maintain things under certain control with calibrated strikes that do not trigger direct confrontation with Israel. But as we have seen over the past 3 weeks, things can get out of hand and miscalculations are possible. And especially now in a context in which a lot has happened, which has changed the rule of engagement between the two sides, it is possible that escalation happens. But at the same time, I think it's very clear that neither side seems to want to go in that direction. So if that happens, is an unintended consequence of the tensions and developments of the recent weeks.
Anisa, I know that you believe that Israel may have got something in response for a more limited strike against Iran for scaling back perhaps what had been bigger plans. What might that be?
Well, I think there were a lot of negotiation happening probably behind the scenes. It took 6 days for Israel to retaliate to the 13th of April attack by Iran. And I think that was mainly due to negotiations with Western partners, in particular the United States. We have seen already that the West, the US and the EU, and I think other countries as well, but in particular these two blocs have been implementing, adopting, and promising to adopt more sanctions against Iran, in particular against Iran's drones and missile program, which we know is a big concern for Israel and for other countries in the region. And I think this is one possible lever of influence by the West towards Israel to, if we wish, limit the type of attack that it conducted against Iran. It's possible that we are going to see more sanctions, and there is discussions about what this might look like, even potentially on the exports of oil and basically the implementation and enforcement of existing sanctions, but also the listing of the IRGC, the Revolutionary Guard groups, into the terrorist group by EU countries. This is all in the cards. This is all an ongoing conversation. We don't know which one will be applied, but I think it's going to be something that the Western countries are going to keep in their on their table for a long time.
Anisa, we did see huge protests in Tel Aviv over the weekend, obviously, you know, against Netanyahu. If something were to happen and he was to not be prime minister, would it change the course of this war at all?
Well, it's a very good question. I think we know that Israel has maintained a very hawkish position towards Iran, no matter who has been in power. And especially given the latest developments, the war against Hamas since the 7th of October, I think this is unlikely to change drastically. I think the focus might shift slightly depending on who is in power, but the antagonism between the two is unlikely to change. Bibi Netanyahu, however, has historically taken a very, very forceful position against Iran. We know that he was a proponent of strikes against Iran already back in 2010, and already back then, the Western countries were able to refrain Israel from conducting an attack in Iran merely through the adoption of sanctions. So we know that this position is very peculiar of Netanyahu, but there is going to be some continuity no matter who is going to be in power.
Anisa, thank you so much for your time today. That's Anisa Basiri Tabrizi, Senior Analyst at Control Risks.
My pleasure.
Plenty more still ahead. Do stay with us on Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Let's turn now to luxury timepieces, and monthly Swiss watch exports have dropped the most since 2020 as demand seems to be plunging in key markets, including China and Hong Kong. This all as higher interest rates, shaky economic growth and geopolitical conflicts lead consumers to reconsider perhaps splashing out. Joining us now is George Karen. He's CEO of Swiss watchmaker Breitling. Thank you so much for joining us, George. And
Good
just
morning,
to point
Wayne.
out, I left my wrists bare just in case, but I see you didn't bring anything extra with you. No, do tell us in all seriousness, why this drop-off suddenly after 3 years of booming Swiss watch sales?
What you have to look at is a long-term trend. And if you look at the watch industry or the luxury industry in general, since the 1980s has been booming. And I'm convinced that this trend will continue. Of course, you have a bumpy road right now. You have political instability. You have inflation in many countries. And all this impacts what we call the consumer sentiment. So some people, especially I would say in the entrance luxury price point, are postponing their purchases. What is interesting to see, though, that the high luxury, the really expensive pieces are doing extremely well.
Extremely well. Well, your strategy over the last 7 years has been working really, really well. So you tell us, what does a Breitling, with you in charge, do at a time like this? Do you lean into the very high end?
You're right. We have been doing very well, but it's a package of elements which make a brand more successful than others. Because in a crisis, what you need to do is to overperform the market, so be better than competition. And it's better products, nicer products, better marketing, communication. Being closer to the consumer through our boutiques, for instance. And this is why we outperform the market.
So what does that mean if a retailer decides to discount? Do you have any control over that? Do you want your brand associated with discounting? Is it fine?
No, it's not fine. No brand wants to have its product discounted. Thank God we don't have that problem, especially the secondary market is much more structured, what we call certified pre-owned. You have much less what we call gray market, people selling watches because they need cash. So I think the market is much more structured, and no, I think we are a strong brand and the retailers respect our pricing policy.
So obviously you mentioned China, the weaker demand from China has been pretty much a big drag. When do you see China luxury demand coming back? Given that we saw better than expected growth, but it does seem that the economy is not...
I think nobody in the luxury, we're nowhere in China. It's a 1.6 billion country. There are only 200 or 300 million people in that country who have access right now to the luxury products. I just came back from China. If you look at the second-tier cities, third-tier cities, cities you've never heard about it, with 10 million inhabitants, the potential is huge. Again, the market will grow in the future, and sometimes there will be some dips. But the potential also in India and in so many countries is phenomenal.
Are you seeing it as a bit of a land grab opportunity then right now? Is that why you're just back from China?
Yes. And I'm flying tomorrow to India. So there are countries with phenomenal potential.
Yeah. What about the United States? Because I imagine in the past you've depended on, the wealthy bankers and the billionaires of the United States. How are they doing? What are they liking at the moment? What price point?
The U.S. is doing fine. You have this problem in the U.S. Because of the interest rates, in particular for housing, and they have flexible interest rates, and they have been raising, and I think that's a big problem. I hope that the interest rates in the U.S. will go back very soon, and this will help. And we, as a Swiss company producing a Swiss franc, obviously we have a problem because the Swiss franc became so strong. So whatever we gain in the U.S., we might lose a portion of it because we obviously report in Swiss francs.
Exactly, and you're obviously looking at what the Federal Reserve does just as much as everybody else. So when the market drops like it has for the last 6 days in the United States, does that concern you?
Indeed, we see also that there's a correlation between the market development and the consumption in luxury goods.
Sure.
But I'm still positive. I'm still positive.
Talk to us about your quartz inclusion, because it wasn't something that Breitling typically did much of, and it seems to be a bit more popular now. Is it because it's popular with the consumer?
Yes, we want to be approachable as a brand. When we talk about exclusivity, of course we talk about pricing, we talk about accessibility of the product, but intellectually, especially our sponsorship, our partnerships are all approachable. We're not in golf and tennis. We're in surfing, for instance. With Kelly Slater, we are in triathlon. We try to be approachable as a brand, but of course we remain exclusive because of our distribution and the price.
But those are also very adventurous and sort of extreme type sports, right? That must be a little bit of a strategy too.
Absolutely, especially after this COVID area where people are searching for freedom, carpe diem, enjoying life, and all these sports give that, and the society changed a lot since COVID.
Where are you spending your marketing dollars? Facebook, Instagram? What's the new place to spend it?
Indeed, we spend nearly 70% of our marketing dollars in social media because it's there where people make their choice. It's where customers get the information. But it doesn't mean that they buy online or through e-com. They buy in boutiques. So they get the information online, but they want the physical experience of the brand. And this is very different.
The pre-owned market has dropped off quite substantially. If that's the case, then what would you want to have as the price point that you sell at? How do you attract people who know that this is not maybe something that they'll resell in the future?
After COVID, everything boomed. And I think in both in the primary market and the secondary market, the market has normalized. Let's not forget that we are far ahead of pre-COVID. Of course, some brands suffered since last year, but the year after COVID was totally absolutely not normal, and the market normalized. Also, the certified pre-owned market now decreased a little bit, but is still at a very high level and has been normalizing. So we shouldn't compare it to the post-COVID year, but we should compare it to the year before COVID. And here, the whole industry is doing very well.
I'm a VP at Goldman Sachs. We didn't do too badly last year. What's the watch that I pick out of Breitling?
For instance, this one, it's a tourbillon.
No, you told me that was $25,000 worth.
Yeah, but
really?
you're at Goldman Sachs, you can afford it.
Okay. What is the most popular watch right now?
It's a Navi timer. It's obviously the Navi timer line, which is our iconic product, and we just launched the 41 millimeter GMT and automatic, and it's been doing very well.
Any plans for a smartwatch?
No.
No dice.
No,
it's Swiss
no.
after all. There's no way you're getting smartwatches out of the Swiss. All right, don't forget to take your watch with you. Definitely don't leave it behind.
I'm holding it.
That's George Caron. He's Breitling's CEO. And coming up, we'll talk bankers. Europe's biggest banks, indeed, picking up the baton following mixed results on Wall Street. We'll bring you their earnings previews next. This is Bloomberg Daybreak Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Europe's biggest banks are picking up the baton this week after mixed results from Wall Street peers. According to Bloomberg Intelligence, with shares trading near a 6-year high, the outlook for lenders may be ripe for a reset if earnings disappoint. For more on the earnings now, Bloomberg's Chloe Melly joins us. So, Chloe, what are the main themes to be looking out for this week?
Well, as with the last couple of quarters and probably with the next few, the main focus really is going to be still on the slowdown in net interest income. And that is likely to affect most, if not all, of the lenders reporting this week. And that is also despite the fact that expectations for rate cuts have been pared back a little bit. Lenders are probably going to still report quite sluggish net interest income. And then if we look at, so that's kind of across the board, but if we look at specific banks, a key theme for banks like Deutsche Bank or Barclays is also going to be the performance of the investment bank. So in general, that's an area of banking where we've seen quite a lot of reorganization. So any indication that activity is picking up is going to be quite welcome.
What challenges will the banks face this year? I mean, obviously we saw out of the US, net interest income is going to be under a little bit of pressure, and also the uncertainty around what the Fed will do. But there's more certainty about what the ECB will do.
Yes, there will be, but net interest income is still going to be quite an important theme. And related to this idea is going to be the idea of cost control. So there's this metric called operating jaws, the difference between revenue growth and cost growth. And that is going to be really a key metric to look out for. So, for example, costs are likely to rise at a faster rate than revenue for both the big Nordic banks reporting this week, Handelsbanken and SEB. And obviously we know that banks in Europe have made job cuts, reorganized their operations. So the focus is really on boosting profitability as the boost from interest rates fades.
So last week out of the US, we did get a little bit of a surprise in the sense that I'm not sure people were really expecting that Goldman would be the one to surprise, right? And then we saw these huge share moves for the likes of JP Morgan and so on. Is that the kind of market action we'll see this week? And which bank will be the winner, do you think?
Oh, I cannot make a call on which bank will be the winner. I think what we've seen is that there's been quite a lot of regional divergence in terms of banks in Europe. So and this week it's going to be primarily Nordic banks and UK banks, and they've not been as resilient maybe as some Southern European banks, but they are reporting a little bit later in the season, Italian and Spanish banks.
All right, well, we'll have to wait till all of the scorecard is in order to make any kind of a judgment. Yeah. Chloe, thank you so much for all your insights. We'll be following your reporting throughout the week. That's Bloomberg's Chloe Melly there. All right, let's take a look at where we stand markets-wise as we head into a new week after a very, very action-packed filled last week. We did see the S&P below 5,000. We're back above it now again, at least in terms of futures. We'll see if that holds throughout the Monday session after massive sell-offs in the likes of Nvidia, some of the tech companies. Also, the semis got hit hard. Intel reports this week. So does Alphabet, Microsoft, Tesla as well. So we'll be watching for all of those. NASDAQ 100 futures also pointing to a nice gain at the open. If we look at treasuries, it's going to be a hefty week for treasuries issuance. We'll see if that two-year yield goes beyond the 5% mark, but we certainly met it. The 10-year yield is at 465.99, and of course the 30-year yield 474.59. So we'll be watching that curve closely. And then if we look at oil markets, it's been fascinating to see how that risk premium has been coming out of those oil markets. NYMEX crude is now at 82.45 and Brent 86.54. That's a $5 move. Do stay with us heading into the European day. This is Bloomberg.